am Ben Reppond. Today is August 28, 2024. I want to give you just a backdrop on what's gone on the last week. As you probably know, the Fed is weighing whether to cut rates in December. Through their Jackson Hole meeting, Chairman Powell gave reference to the fact that they're probably going to cut, and maybe even cut aggressively, and with more cuts to follow in the coming year, through the rest of this year. So what is that going to do to the economy? What is it going to do to the stock market? My focus is a little more on the stock market, but we don't know. I think it sounds like my inference into it is probably a 50 point basis cut, but it could be 25. Is it going to be 100 basis points to the end of the year? We don't know that. So a lot of variables, but I would say that the counterbalance to cutting rates right now, going the other direction, is the amount of jobless claims. That number was revised upward, meaning way more people were without jobs, jobless claims, by the tune of 818,000 jobs, more than had been already revised from previous data. So revision on top of revision. Why could they miss it? Let's just say almost 1 million jobs. They had access to all the data that you and I don't have access to, and then they had access to revise that. After the revision, how did they miss it? Almost 1 million jobs. It just makes me suspect. I just don't trust the government to give me accurate information. And here it is again by a big number. So what does that mean? It means the economy is weaker than they're trying to spin it. And I think it is a lot of spin. And when you listen to the talking heads, which I listen to, it's mostly spin, trying to convince you that things are better than they really are. So I'm not a negative person, I just want the truth. The problem is we're not getting the truth. Okay, let's get into the data. I'll give you the dashboard. This is amazing. So here we have, this is not the economy, it's not the jobless claims, it's not the interest rates, it's not the inflation, it's the stock market. So when we look at all 7 of the indicators, they are all positive for all periods of time. Okay, so I'll go through this. In the left column, the yellow box, you see how they did this past week. Every one of them, including the long-term government bond at the end, positive. It was a good week. Next to that, to the right of that, is the pink box. All of the equity indexes were positive, and this is year to date. The long-term government bond slightly negative by 0.5%. And in my opinion, not alarming. When you look to the right of that, all of them, relative to their 20, 50, 100, and 200-day moving averages, all positive. Very positive indicator. When I go over to the sectors, these are the components of the S&P 500. So you have 11 industry sectors, energy and technology, utilities, retail, consumer staples, et cetera, 11 of them. They are all positive to the right of the chart. You can see they're all positive relative to their 20, 50, 100, and 200-day moving averages, except for energy was slightly negative for the week and is slightly negative below its 100-day moving average. Other than that, all of them positive. So very strong indicator. Energy is not, it's not that negative. So This is a chart, a line chart, a weekly line chart for a 24-month period of time. So what it means is that if it goes down, that's down for the week. If it goes up, that's up for the week over a 24-month period of time. So that would be 104 data points on the weekly. And you can see at the very far right, upper right of the chart, it's moving upward. So it bounced off of its 200 or 20-day moving average and moving in an upward direction. There is nothing negative about this. This is positive. The economy may be negative in certain segments or certain areas, entirely possible. The dollar could be negative, aspects of the economy, etc., but the stock market is positive. So glad to report that. When I take that, I'm going to compress it down from 24 months down to 18 months, and then I'm going to convert it over to a candlestick chart. This gives you a little bit different perspective on the data. And you can see at the far right, upper right of the chart, I draw a line up to that point. The upper right of the chart, you can see that this is the S&P 500, has moved up 3 consecutive weeks, indicated by the hollow candlestick, the last 3 candlesticks, all being extremely positive. Prior to that, it was a down period, but then a very quick recovery. And then you can see a little more, I won't say macro, but a little more intermediate term, where you can see over that 18-month period how it has moved up. It had slight corrections and continue to move in an upward direction. So I would say right now the stock market is positive and moving in an upward direction. I don't want to imply anything about the future beyond that, but for that period of time, I would say positive. Now I create a chart showing the relative strength of the NASDAQ 100 to the S&P 500. So this is the tech-heavy index relative to the broad market. So when it goes up, it favors the tech-heavy index. When it goes down, it favors the broad market. And you can see it's below its 20-period moving average. It's a weekly chart, below that 20-period. But generally speaking, based on my black line, it's moving still generally in an upward direction. When we take the S&P 500, we break it into 2 parts, only 2 parts. There are 11 sectors, but if we just take the 2 broad parts of the market, one is growth, one is value. And when this line chart goes up, it says that growth is in favor. When it goes down, it says value is in favor. And so there have been plenty of both. But generally speaking, it is moving in an upward direction, which is favoring growth-type stocks. Again, this last week and over the past couple of months, it has been moving more down than up, which has been favoring value. The S&P 500, large companies, this is 500 of the largest companies in the stock market, compared to the small cap index, the 2,000 smallest companies in the stock market, measured by IWM. IWM is the symbol for the small cap index. So you can compare SPY to IWM. When I put those in a ratio, it shows that generally speaking, from March of 2023 to present, it's moved in an upward direction. This last week, as you can see at the last far right of the chart, there's a tick down, and that means that it favored actually small cap over the broad market just this past week. Long-term government bonds have, this is a, excuse me, a 5-year chart looking over a 5-year period of time. Long-term government bonds, and actually all government bonds, have been moving in a downward direction. At the very end of this chart, for the last couple of months, you can see that it has been moving in an upward direction. So that means that interest rates have been coming down, which has been, or the perception of interest rates going down has been pushing the bond market or bond ETFs in an upward direction. So that's good for traditional portfolios. But I still see it in a long-term downward direction, at least at this point. The dollar, over this is a 3.5-year period of time, the dollar has been going up relative to other currencies. You can see that because it's been moving in an upward direction. However, recently, and this is over the past 3 months, recently the dollar has been coming down relative to other currencies. So weakening. And I've been reading information that's been confirming that the dollar is weakening. But it's not weakening just by itself, it's weakening relative, because all currencies are relative to each other. So when you evaluate the dollar relative to other currencies, it's weaker, but just in a short-term period. So I didn't draw a long line here. What caught my eye was the downward pressure on the dollar just in the last 2 or 3 months. Gold, on the other hand, it's an asset that's oftentimes counter to the dollar. Gold has continued to go up, even this past week. So you can see the long-term direction of gold is up, and the short-term direction of gold is up. Silver is a little bit different than gold. It's more dynamic. It moves up and down more. It's more volatile. In full disclosure, I'll tell you, I own silver. I don't own gold. I have owned gold. I don't currently own it. I like silver not because of this reason, but for other reasons. But it's been on the move in an upward direction. Silver relative to gold, I didn't put an arrow on this. Silver relative to gold goes up and down a lot. So sometimes gold outperforms silver, sometimes silver outperforms gold. But as you look over the last couple of years, not a lot of change. A lot of up and down, but not a lot of change. And this last week or two, couple of weeks, silver has been moving up more than gold has. But prior to that, there was some downward pressure, more on silver than on gold. Bitcoin continues to go up. It's not moving up rapidly. This is a slight move up. This last week was positive, and over the last couple of years, it's been moving in an upward direction. The volatility index, the VIX, VIX, has been going up and down. It went all the way from around, down as low as 12-ish, to as high as 65. That's a very high move. That's way beyond the scope of this chart. Whatever computer screen you're looking at, imagine the VIX on an intraday basis. This goes back 2 or 3 weeks. Intraday basis went all the way to 65. The top of this chart is 32. So you're going to have to go beyond the screen of your computer to get to 65. That's how high it went intraday. And then it quickly came back down, all the way down to 14, and now actually had a bump up this last week, all the way up to 15. Even though all the markets I just showed you this, the market came down, the market went up. That would tell you that the volatility index would probably come down some. But what's interesting is it actually went back up a little bit. I don't know why, but you'd say over the longer term, volatility is coming down. Asbury Research, as of last Friday, had all 6 of their indicators positive. 6 out of 6. Cross-asset allocation relative performance. This compares one asset to another, again, out of Asbury research. So stocks versus, I'm going to just look at the ones that are the last week, the last month, the last quarter. If they hit all three of those, I'm going to mention them. So stocks relative to bonds, stocks are stronger. Small cap versus the broad market, small cap is stronger. Developed markets, mostly Europe and Japan, stronger than the U.S. And the U.S. is stronger than underdeveloped markets, not just the BRICS nations, but other underdeveloped markets. Bonds, corporate bonds, are doing better than government bonds. Now we get to this. There's a lot of countries. This used to be heavily U.S., but now there are other countries that are doing better in their equity markets than the U.S. And then U.S. is doing better than a few, but there's like twice as many doing better than the U.S., and I'll mention those. They are Canada, Switzerland, Italy, Germany, Spain, the U.K., Japan, Singapore, South Korea, Thailand, very interesting on that. We'll take a look at that chart. And the broad Pacific market in general, region, New Zealand and Australia. The ones that U.S. is doing better than are Peru, Mexico, India, China, and emerging markets. Interesting. 5 markets that we're doing better than, and the others are either mixed or they're doing better than us. Now, I've shown you this. I've used Thailand as a proxy for other countries that we have done better than. This is still a chart that is better than other charts, just from a charting perspective. But Thailand has started to do better than the U.S. market. Not the currency, not the economy, just the stock market. So, and you can see that from at the far right, upper right of the chart, the degree to which it points down tells you the degree to which Thailand is doing better than the U.S., or the degree to which the U.S. is doing not as well as the Thai market. Okay, let's jump over to gold and silver. As of last Friday, the spot price of gold was $2,516, and that's up 0.2% from the previous Friday. And silver is up to $29.89, almost $30 on the spot price. That's up 3% over the previous Friday. The gold-silver ratio is 86-1. And we get over to a monster box. This is 500 rounds of generic silver, $15,570 for a monster box of silver, including a markup on top of spot, the $29.89 price. You put on top of that $1.25 and you get to $31.14. It is currently selling, according to my son Preston, selling for 1 ounce, $31.14, or 500 ounces, $31.14. That tells me, my opinion only, it tells me it's a buyer's market. And $1.25 with no minimums, that's favorable to the buyer. Okay, hopefully this is helpful to you. I will mention this. I'll probably be mentioning it more and more. Our investment model, we have many strategies, and we have been working on and have developed an AI model, artificial intelligence, where the computer sorts through millions of combinations of data and 41,000 data points, and comes up with a predictive model to say this is what's going to happen in the future. We made a misstep in that in the spring, in April, And I admitted that. I told that to clients, and there was a data flaw in there. We corrected that. We have now started tracking it live. We've not opened it up to client accounts yet, but I'm very excited about the possibility of the use of AI with investing, being able to determine what is going to produce the best rate of return at the lowest risk. And so we're testing that. I'm excited about it. I'll report more on it in the future. All I just wanted to say is it's something that we're working on, and a lot of opportunity there. What's interesting to me is so few financial advisors even embrace this. I mean, some of them just openly reject it as a possibility. Why? Because they are married to the past. They believe in what was developed 50 to 70 years ago, and they're sticking with it. And in my opinion, that doesn't work. So I'm usually more aligned with the individual investor and not as much aligned with the traditional financial advisor. Although I have many financial advisors who are friends of mine who I respect, but the thinking with most traditional financial advisors, in my opinion, is stuck in the past. And most of them that I've talked to reject the use of AI, in my opinion, to their peril. So I'll report more on that as we go along, and I'll be upfront. I will be transparent about it. I will say as much as I can, but I'm not going to shy away from it. So thank you for watching. If you have questions or comments, please leave them in the comment section below.